Hey, welcome to the exchange. This is an article from last week on Bloomberg. So, Carvana woes settle hedge fund CAS with unprecedented year-to-date 43% loss. So Clifford Sosin runs CAS, and it's just been absolutely imploding. So what they do is they take concentrated bets in a handful of companies. I believe they have like 7 or 8 different companies out there, which 25% of their actual portfolio is in Carvana, which you haven't tracked Carvana. It's a used car dealer all over the U.S. But year to date, or yearly since last summer, I mean, it's just been on a steady downtrend from the 300 level down to, I think now it's like sub 50 or around 50 overall. So it's just been a very, very strong decline. But I'm going to pull up a thing right here. I want to just see. So basically what he's saying here, basically in Sosin's basically annual letter, 25 pages, basically entirely focused on Carvana itself. He's saying, hey, he's saying weak unit volume overall should be fixed as basically industry normalizes. The problem is though, right now the unit volume is down, but what's going to happen though later on is you're going to have unit volume increase, but then margins will come down too as basically the auto industry right sizes itself, kind of in a post-COVID era in 2022 and 2023 timeframe. So this is actual CS's actual trades. I mean, they're an early believer in Carvana back from 2018 timeframe, and they've just been buying and buying and buying. Now there are some sells you see back in April 2020. You see some sells in November 1st, 2020. Again, but he's actually probably still above water most of his positions. I mean, most of these positions were acquired in the 30s to 40 price range. Again, he bought some stocks, obviously in the high points. He didn't sell near the highs at all. I mean, he's really kind of been holding overall. So actually, on position basis, actually probably still up. But I mean, obviously, looking at these like actual highs on a paper value, basically on an asset value, he's way down. But yeah, I'm gonna drop this link in the comment or this description down below. That way, you guys can look on this in your own time. I think it's a great website. It's called Cheaper Than Guru. It follows some of these kind of bigger funds overall. So you look at their actual insider transactions or actual transactions they actually have. They're actually reported. Kind of see whether they're buying or selling, etc., and kind of see what's going on behind the scenes a little bit. Now, what's crazy for CAS is look at the number of shares here. So 3.31 million, $320 million current value. You remember, like Carvana's about $11 billion market cap company. So he's just roughly a 3% stake in the actual entire company of Carvana itself. I mean, it's just a massive stake for a company that's going to have a lot of trouble, later this year and probably in 2023 potentially too. So I pulled their balance sheet. This is off their last 10K, which should be from last February, but this is basically reported for 2021. Again, look at their assets real fast. So cash equivalents, $400 million, restricted cash, $233 million, which basically is cash they can't touch. Basically, it's allocated for certain reasons. It could be collateral or something else out there. But again, I mean, they're not a very cash-heavy company. It is very much a debt-financed overall company. Look at the actual liabilities themselves. So total current liabilities, $2.89 billion. Total long-term debt is $3.2 billion. So, I mean, they are a very cash light and inventory heavy and also debt heavy company itself, which again, if they're growing and they're actually adding profit there, it's not a big deal. If that growth stalls out or stops, I mean, it's going to be very, very dangerous because they can get very underwater very fast based on their interest. So before we get to the actual income statement itself, let's do a little thought experiment here. So think about this. Hey, COVID timeframe, used car demand at all-time highs, inventories all-time lows. New cars are almost non-existent right now. It's really all the used car market right now. So hey, prices are going to go up and up and up. Basically 2020 and 2021. So Carvana should be massively profitable, right? Is that your thoughts? I mean, that's a very logical conclusion to make. But let's dive into it real fast. So this is our actual income statement right here. So again, you see, actual sales growth basically from $5.5 billion in 2020 to $12.8 billion in 2021. So you are seeing that kind of like overall scale and overall growth, basically as car prices actually shoot up, 30 or 40% based on the CPI indexes numbers we're reading. Again, the actual look at nets or the actual gross profit here. I mean, 794 in 2020, $1.9 billion in 2021. I mean, it's really a 3x increase, which that does make sense though too, given the used car market itself, and these are massive tailwinds for Carvana, and they should be very profitable based on this, at least on an operating income level. But then you get down to the actual SG&A cost, which is selling, general administrative expenses. I mean, it literally doubled too. So it went from $1.1 billion to a little over $2 billion. Interest expense, again, they keep adding debt, and it's a very debt-heavy company overall. So it basically went from 131 million to 176 million. So really, after everything else, crazy 2021, crazy car prices, massive margins, on low volume, etc. Basically, it's getting down to $286 million of net loss. Basically before income taxes, which again, it's just crazy to me because you think, hey, this is like the time, if you're gonna be profitable at all ever, this is the time you're gonna do it in. It's 2020 and 2021. But even at scale with everything going, and again, it is low volume. I think what the guy from CS is really saying is as volume increases, margins may not drop that fast. So there'll be a point there maybe in 2023 or maybe later 2022, they actually do have a decent volume with decent margins, and they actually become profitable potentially too, maybe for a quarter or two. That wouldn't surprise me. The problem is though, once the industry actually right sizes long term in 2023 and beyond, I mean they're going to get absolutely killed potentially if they can't handle their debt load as well too. They also might be thinking too, this is what I think Sosin over at CS is thinking too, is hey, they're a young company, they're going to grow. Once they get economies of scale, coast to coast, they're going to basically be able to like have those economies of scale, be able to have data to be able to move cars from like basically like cool spots to hot spots, basically capture the extra incremental margin. The problem is right now, Carvana actually is pretty big. I mean, they already have the actual economies of scale happening right now. And really, they are coast to coast. I mean, they serve most of the U.S. Obviously, you see right here, kind of in the north and northwest. There's not too many actual locations there. But again, where people actually live, there's just like they have the skill right now. So the question is, why isn't the actual profit dropping, or why isn't the actual profit dropping the bottom line, and why are OpEx expenses still so high? You're not really seeing the synergies, even after multiple years, that Carvana has been promising since 2018, 2019 timeframe when Sosin first bought into the actual company itself. So I'm going to end on really 2 points. This is point number one. This is actually from their 10K as well, too. This is basically their business org chart, which, again, if you don't understand this, don't worry because no one does. It's a very just obtuse thing. But really, what the thing to notice here is you have two like dual class shareholders. You have Class A shares and Class B shares. So Class A shares are basically your common stock, which you can buy like CVNA on the stock market right now. Basically, as public shareholders and also Garcia parties, Carvana employees, and consultants and directors, everyone owns Class A shares. Those Class A shares basically are subsidiary. They're open to Carvana Co., which is the sole manager of our Carvana sub. So basically, and that basically has the $2.4 billion of senior unsecured notes. And also as well, they bought some more bond issuance too. So basically anything in the bond market rolls up in the actual Carvana sub right there. But you see right here, these other subs here, there's the Class B shares. So there's the LLC unit holders. And basically what these are basically Class B shares, is 10 votes for every Class B share versus 1 vote for every Class A share. So you see just a massive concentration of voting power with the actual LLC unit holders. So those LLC unit holders actually manage the Carvana Group LLC right there. And that Carvana Group LLC manages another LLC called from Carvana LLC. And what that Carvana LLC does, handles our short-term revolving facilities, which all that means basically is when they buy cars on the actual auctions or from customers, they don't buy it with cash. They buy it basically with debt financing. I believe Ally Financials are basically the loan revolver, which they're heavily involved with actual Carvana itself too. So if Carvana were to actually implode, you probably see Ally Financial take a massive hit. I'm not saying Ally Financial would go to business, but they would take a massive write down based on the actual revolver and also some of their other debt they're actually buying from auto-backed securities. So when we think about Carvana as a business itself, really they have two goals here. Number one, acquire cars. Number two, sell subprime auto loans to banks. That's their entire core business. Now notice I didn't say anything about customer service, high quality cars, quality re-inspections, etc. Which you can go online and look at that Carvana like horror stories, or Carvana reselling, where they're selling basically salvage title vehicles, and basically cars are falling apart after a month or two potentially. But this is actually a slide. It's actually from Spruce Point Capital. It's from 3 years ago. So, I mean, business model probably has changed a little bit. But again, this is kind of really the gist of kind of how they actually operate. So what happens is Carvana basically takes these cars and they acquire these cars. At typically, especially right now, they're acquiring at sky high prices because, hey, demand's so high. So they're acquiring well above market or at the market. So what they do is basically they take those cars, sell them to customers for whatever price they sell them for, package those loans up basically into almost like mortgage-backed securities in a way back in 2008, same style but for auto loans. Basically what they do is they sell those loans off to like Ally Financial, either directly, which the majority of their loans go to. I think it's about roughly 2/3 go to Ally, 1/3 go to either trusts or other banks out there. And then from that, they receive instant cash based on those future receivables, etc. Now, if they sell it to a trust, what happens there is basically they sell to the trust. The trust gives them cash. That trust basically itself is a third-party entity. And then the debt financing of that comes from Ally Financial or another bank out there potentially now. And the actual equity side of the actual tranche comes from an unknown party. It could be a related party transaction. We just don't know. That's one of the big questions you have about Carvana itself too. Who's the actual equity holders of this actual tranche right here? Which, if it's related party, which basically all that means is somebody in the kind of the Carvana family itself is buying that, or basically putting the cash up for. Basically, it's almost like selling a auto loan security to yourself itself. So as the value goes up, you capture more profits, and as it goes down, you lose more money there too. Now, is it illegal? I mean, it's definitely on the hair of fraud right there. I don't know if it's illegal or not. It's really up to the SEC itself. There's also some refinancing happening too. You saw back in the late 2010s timeframe. It might still be happening now. We don't have more current data, but this is from Spruce Point Capital, which they did a great job. Now, obviously, the thesis wise was totally wrong because the stock shot up to the moon in 2020, 2021. But I mean, I think the gist of it now, we're seeing that really now in 2022 and probably more in 2023, is the actual stressor come under as this market flips around, also they're underwater potentially. So very last bit of news here. This is for Carvana. They just announced an upsize, basically senior pricing bond offering. Which again, the thing I noticed here is at $3.275 billion at 10.25%. I mean, this is a very high rate, and it really shows kind of the distressed nature they're having right now in the stock. With the stock going down, the market basically the market flipping right now, where all of a sudden autos may not be as hot as they once were in 2020 and 2021. But again, what this really is going to finance here is called ADESA. Basically, it's an auction data service company. So what they can do with that data is basically allocate or kind of find trends before other people can allocate cars, by geography in a basically more efficient way overall. So the initial offering was for $2.275 billion. So it basically raised it up $1 billion to 3.275, which really what this shows me is they're hunkering down, potentially preparing for a credit tightening, almost like we had 2007, 2008 timeframe. They know, hey, if they're going to raise debt at all, if they're going to ever raise it, now is the time to raise. So they're basically raising for that shock happening maybe in 2022 or 2023 in the auto market itself there too. Again, this is not going to be bad for them. I mean, this is not like this actual they can afford this actual debt load itself, but long term the business keeps declining over time, and this could be a very heavy piece of debt around their neck potentially. It could weigh them down potentially for future growth and like later in the 2020s potentially if they're still around by that point. But again, we'll see what happens with this one. Hey, overall thoughts. I mean, this stock's about to get very cheap. I don't see what's going to stop it, basically, until we have a basic resolution of this credit tightening cycle we're in right now or going into this summer. But again, be sure to sub, like, comment down below, and yeah, that's the exchange.